welcome to our much-awaited result season curtain raiser, Quarter Se Quarter Tak. This is the show where we'll tell you literally what happened fourth quarter se lekar quarter one tak. That is, which companies are likely to report strong Q1 results and which ones are likely to disappoint. I'm Lata Venkatesh. With me, Prashant Nagar.
Hi everyone. In a bit, our own research team will also join us to present their initial poll findings. We will also be joined by three experts who will weigh in on each of the sectors. Nishchal Maheshwari of Edelweiss will be with us. Sanjeev Bhasin of IIFL will be joining in. And Dhirendra Tiwari of Antique Broking will also be with us.
Well, basically, this April-June quarter will show pre-GST destocking impact, obviously, especially in the FMCG and consumer space. Banks, especially corporate lending banks, will continue to dither from high provisioning because of their NPAs, while oil refiners and commodity stocks will not have the benefits of high global prices.
So the big questions we will be trying to answer are these. Which companies are likely to buck these problems? And which sectors must you bet on before the earnings season kicks off?
And finally, whether regardless of Q1 results, which companies you should bet on in anticipation of better second half numbers.
Okay, so what's in store for the first quarter earnings? Let's get a comprehensive snapshot in terms of how you should be going into this result season. Varinder is here with an overview on each sector. Varinder, what are we expecting really? A strong quarter or essentially a weaker than fourth quarter and year before last quarter?
Well, thank you so much. Subdued quarter is everyone expecting. I'll give you the headlines for some of the brokerages. CLSA says first quarter earnings to be weak. Kotak says net earnings of BSE 30 companies to be flat. Morgan Stanley puts a question mark of any positive surprises this quarter. Antique says slowdown but transient. If you look out for the profit growth expectation this quarter for BSE 30 companies, as I said, Kotak is expecting flat growth compared to nearly 10% growth we saw in quarter for FY17, and the chart will come on your screen. Reasons for being muted, of course, the GST impact, inventory losses of some of the, OMCs, some of the soft export performance like IT and pharma this time, and banks' earnings to be flat Y on Y. CLSA says, some of the pockets which could show good quarter this time. If you're watching out for banks or financial institutions, Yes Bank, IndusInd Bank and Indiabulls Housing Finance, these are three companies which could show 20% growth. L&T could surprise with 20% improvement in terms of earnings. And among the autos, Eicher Motors, Motherson Sumi, TVS Motors, they're expected to report good set of numbers, over 20% growth. Power Grid could surprise the markets, 15% growth it is what expected. And DLF, because of a very small base, low base, and of course some of the cancellations what it saw in the last quarter, could see good numbers this time. Companies which could see weak earnings this time, IT and pharma. Clearly pharma, Sun Pharma and Lupin, as per CLSA, there could be fall of nearly 50% in terms of profit. All the consumer companies keep an eye, Marico, Nestle, Dabur, Colgate, because of the GST and destocking impact. Telecom, Jio could have an impact on some of the telecom companies in terms of numbers. Watch out for that. Oil and marketing companies, because of the inventory losses, which we don't know, that could impact the earnings this time. And steel companies, quarter on quarter, because of the lower steel prices, you will see, earnings moving down on a sequential basis. Some mid-cap other stocks which could surprise the markets, GE, TND and Gayatri Projects, you could see over 100% growth in terms of profit this quarter. NCC could see profit jumping up by nearly 45%, and Hindustan Zinc could see profit jumping up by nearly 70% this quarter.
Thank you very much, Varinder. We will get some first thoughts from our experts. Dhirendra Tiwari, the head of research at Antique Stockbroking, is with us, as is Nishchal Maheshwari, head institutional equities at Edelweiss Securities, and Sanjeev Bhasin, executive VP Markets and Corporate Affairs, IIFL. Gentlemen, welcome. Let me start with you, Nishchal. Overall flat, is that what you're going with, or actually lower?
So I think if I look at it, you will have a negative earnings basically for the current quarter. So we are around -2% as far as earnings is concerned. But I think the top line seems to be doing pretty well. So there is a healthy 12% growth as far as top line is concerned. And if you dig it a bit deeper, basically it is largely being driven by the OMC's fall in inventory losses, basically, that is coming up, and that's why the profitability part is pretty subdued. But if I look at ex-OMCs, and ex-OMCs, our coverage shows basically a 5% growth in the profitability also. So I would say basically it's a muted quarter, but I think a good surprise on the top line.
Dhirendra, what about you? First thoughts overall? Earnings subdued this quarter?
Yes, as you would expect that the consensus is very known. So, there is a 4% decline in the companies under our coverage. And if one looks at the Nifty, it is also close to 5% decline year-on-year earnings. Now, obviously, this is driven by losses expected to be incurred by the OMCs and also Tata Motors. Tata Motors is expected to report weak quarter this year-on-year, and that is also going to affect the earnings. So I think the overall weak quarter, so there are many points to be washed out in this particular quarter. One of the important thing to notice will be what is the extent of slowdown as reported by the consumer white good and consumer durable companies in this quarter. We don't know exactly what is the extent of slowdown, and if that is not something which is very meaningful, then we will have a much better outlook for the rest of the year.
Okay. Sanjeev, one sector you will bet on before I get to the individual sectors?
Well, steel. We think that can be an outperformer, and we know prices have hardened globally. The Trump protection policy should be very bullish, and steel has been clearly an outperformer. Also, the slowdown and environment issues in China have seen a lot of output from there being cut down, which has given Indian steel companies to be in a very sweet spot. It's evident in the price of Tata Steel, which has led from the front, but we think JSW as an integrated play and SAIL on the export side. All these three are going to be a surprise on the upside. Already we know Tata Steel last quarter reported the best ever, I think, EBITDA per ton, and I think this quarter could also see a similar result coming from Tata Steel.
All right. Well, that will be certainly good news for the corporate lenders if steel generally is doing well, because that's where a bulk of their problems lie. But we'll do one thing. Let's invite Nigel. In fact, our entire research team is standing by. But since Sanjeev has chosen to kick off with the metal space and Tata Steel, over to you, Nigel. What are you expecting, or what's the street expecting from metals?
Well, in Q1 FY18, expect the good run to continue for the metal space. So expecting strong earnings coming in from there. Base metal prices, they've been rock steady. In fact, in the last 1 year, they're up between 20 to around 30% as it's displayed for you on the screen. And from the ferrous space, we have HRC as well as long prices that are up between around 13 to around 16% on a year-on-year basis. Capacities, they have been coming on stream. That's what will help the earnings, particularly in the case of Vedanta, as well as Hindustan Zinc. And if you take a look at some of those companies, operational performance will be better because capacities have been coming on stream, so operating leverage really will play through over there. Some of those companies that will do quite well on the back of higher volumes will be the likes of Tata Steel, NMDC, as well as JSW Steel. And finally, if you just sum things up, ferrous players, well, they'll gain because spreads will be better. And in fact, non-ferrous players, they'll be gaining because LME prices have spiked up and capacity utilization levels as well have moved higher.
Okay, let's do one thing. Nigel, thanks very much for that. Let's bring in one more sector, discuss what the basic expectations are, set it up, and then sort of throw it open to our guests here. So from old economy, let's talk about a new economy sector. IT is what we are talking about. Expectations, prima facie, don't look very bullish, but Rima has got the lowdown on what to expect as far as companies go. Rima, over to you.
Yes, as always, we start with IT, Infosys and TCS this week. Typically, the June quarter is a seasonally strong quarter, but that perhaps may not be the case this time around because the expected pickup in BFSI, which contributes nearly 25 to 40% of the overall revenues, has not materialized, contrary to early expectations. Retail healthcare continues to remain under pressure and a bit challenging. Pricing pressure in the commodity business or the legacy business is also an added headwind. So organically, if you look at the constant currency growth, CLSA expects it to be anywhere from -3% to +3%. At the margin level, the rupee appreciation of 3.5% against the dollar will hurt, though most companies, barring Infosys and Wipro, have deferred their wage hike. With respect to Infosys, watch for whether the company maintains their FY18 constant currency revenue guidance of 6.5% to 8.5%. Currently, the street expectation is that it will be met.
Okay, well, that's the expectation which Reema has picked up. But Dhirendra, over to you. IT has been a dog of a performer for the past few quarters. Do you think this quarter will hold any surprise at all?
No, I don't think so. As it was told very clearly that BFSI is not something which is doing pretty well, and so is retail. So we are also expecting the growth to be -1 to +2.5%, and the larger companies doing probably on the lower end of the growth trajectory. So I think they are clearly having tough time, and I don't really personally think that the situation is going to materially change in 2Q or even maybe 3Q. So this is going to be another tough year for IT industry. The only thing which goes in the favor of IT companies is the valuation, which is reasonable, but as one would say that it is no meaning unless there is growth. So it is going to be tough here. So we remain sort of neutral to slightly negative on the sector as a whole. But if at all one has to look at one stock, it could be Infosys.
Oh, fine. We'll keep that in mind, Infosys. But I guess this quarter, the most important sector that everyone will watch out for will be FMCG. It is going to be a pre-GST quarter. We have heard enough and more about destocking. So we'll get Mangalam's lowdown on what he has picked up in his poll of brokerages and then quiz our experts. Mangalam?
For the consumer staples sector, after 2 quarters of demonetization, just watch out for 3 letters, GST. Yes, indeed. Destocking is likely to take a toll on revenue as well as volume growth across the sector, especially the likes of Colgate, Emami as well as Dabur. They have a higher exposure to the wholesale channels as against HUL, ITC and the likes. Also, watch out for the companies which have exposure to the Middle East and North African region. They will have problems which will continue for them. Most importantly, though, I will be watching out for management commentary post-GST, demonetization, good monsoons. What sort of recovery is expected, especially in the second half of this fiscal? Back to you.
Mangalam, thanks very much for that. Nishal, you want to come in on this sort of group of stocks? Growth has been slow. This quarter would be poor, but will the markets look through it? Because it's well advertised, right? I mean, the GST impact.
I think so, basically. I don't think so the market is going to take it very negatively. Given that there has been a good monsoon, there has been quite a bit of loan waivers we've seen across the country in a lot of states. I think this is all going to help most of the FMCG companies, which is largely driven by the rural demand. So I think this is going to be a one-off quarter for the FMCG sector, and the coming quarters I see good strong growth coming back for them. Okay.
Well, let me toss that as well to Sanjeev. Your pick. See, the problem with FMCG also is that it's extremely well priced. I mean, 38, 40 times, which was the brokerage which said that some of the prices are indicating that they have to grow at some 15 to 20% CAGR for the next 20 years. So, Sanjeev, will you buy any of them?
Well, no, I mean, we have to be stock selective. So if you wanted to add, a United Spirits in that basket of FMCG or beverage, then United Spirits and Tata Global are 2 stocks which we've been very, very bullish, and we think they will buck the trend and show you higher numbers. On lever at 50 times, I think Palmolive oil being at the low could help on the margin. But ITC will be a no-brainer unless we see some more output on the cigarette side, since their FMCG margins have been a lag even in the last quarter. So some of parts we don't want to buy stocks at 50 times or an ITC at 38 times. We'd like we said, United Spirits and Tata Global are 2 of our preferred picks.
All right, gentlemen, please stay on. We have to take a break. We have got our research team with us to analyze a lot more sectors, and of course auto will be the cynosure of every investor's eyes. Pharma and banks, the other 2 which have their own problems. All that coming up for you in a minute after this break.